The hidden power of MACD. How to avoid false signals and detect real trends. Have you ever entered a trade only to watch the market reverse immediately? Or maybe you've been trapped by indicators that seem to generate endless buy and sell signals, only for price to move nowhere? The reality is that markets move through different conditions. Sometimes they trend strongly, sometimes they become choppy and unpredictable, and sometimes they move inside a range. The problem is that many traders use the same strategy in all three conditions. That's why they experience unnecessary losses. In today's video, I'm going to show you 3 real examples from this Eurus chart and explain how the MACD can help you. Detect strong trends. Identify choppy market conditions. Recognize ranging markets. Filter out low-quality signals. Avoid trading noise. By the end of this video, you'll understand why professional traders pay attention not just to MACD crossovers, but to the size and strength of MACD peaks. Let's begin. Case 1. Strong trending market. Let's start with the left side of the chart. Notice the red trend line supporting price as the market continues moving higher. Price is creating higher highs, higher lows, strong bullish momentum. Now look at the MACD below. I've highlighted 2 green areas where MACD peaks are expanding significantly above the zero line. These large MACD peaks are extremely important. They tell us that momentum is increasing. Buyers are in control. The trend is healthy. The market isn't simply drifting upward by chance. Momentum is actively supporting the move. This is exactly the type of environment where trend-following strategies perform best. Many traders only focus on whether MACD is above or below zero. However, the real edge comes from observing the size of the MACD peaks. Large peaks mean strong momentum. Strong momentum means a higher probability trend. When MACD expands aggressively above zero, it confirms that the market has energy behind the move. This is the indicator telling us momentum is strong. The trend still has fuel. Case 2. Choppy market. Now let's move to the blue unfilled rectangle in the middle of the chart. This area represents a choppy market condition. A choppy market is a market that appears to be moving, but lacks enough momentum to establish a clear trend. Notice what price is doing. The market is moving sideways. Candles alternate between bullish and bearish. There is no sequence of strong higher highs and higher lows. There is no sequence of strong lower highs and lower lows. Price simply moves back and forth without commitment. This is one of the most dangerous environments for traders because it creates the illusion of opportunity. Every small move looks like the beginning of a trend. Every pullback looks like a reversal. As a result, traders are constantly entering and exiting positions. Now look directly below at the MACD inside the blue rectangle. Notice how the histogram bars become much smaller compared to the large green peaks we saw during the trend. The MACD line also flattens. Momentum is shrinking. This is the MACD warning us that market participants are undecided. Buyers are not strong enough to push a sustained rally. Sellers are not strong enough to start a sustained decline. The market is essentially fighting itself. Because momentum is weak, trend-following signals become unreliable. You may see MACD cross upward. Price moves slightly. Market reverses. Then, MACD crosses downward. Price drops slightly. Market reverses again. This cycle repeats over and over. These are what traders call whipsaws. Whipsaws are responsible for many unnecessary losses because traders mistake random price fluctuations for genuine trends. The blue rectangle demonstrates an important lesson. Small MACD values near the zero line often indicate a choppy market where false signals are more likely to occur. Instead of aggressively looking for trades, experienced traders become more selective. Many will wait for MACD to expand significantly before committing capital. In simple terms, large MACD peaks equal momentum. Small MACD peaks equal noise. The blue rectangle is a perfect example of how MACD can help traders identify choppy conditions and avoid getting trapped by low-quality signals. Case 3. Range market. Now let's look at the third example. Notice the red horizontal line above acting as resistance and the purple horizontal line below acting as support. Price is trapped between these 2 levels. The market keeps bouncing from one side of the range to the other. This is a classic ranging market. Many traders make the mistake of applying trend-following strategies inside a range. Unfortunately, that's where many false breakouts occur. Now look at the MACD. I've highlighted the pink areas showing the MACD peaks during this period. Notice that the peaks remain relatively small compared to those seen during the strong trend. Even when price pushes toward resistance, MACD does not show the powerful expansion we saw in case 1. This is a warning sign. The indicator is telling us that neither buyers nor sellers have enough strength to establish a sustained trend. The market lacks directional commitment. Instead, price continues oscillating between support and resistance. Many traders get excited every time price approaches resistance. They anticipate a breakout. However, MACD tells a different story. The weak peaks suggest weak momentum, and weak momentum often leads to failed breakouts. This is why MACD can be such a powerful filter. Rather than focusing only on price action, traders can use momentum to judge whether a breakout has enough strength to continue. The pink rectangles show us that despite price movement, momentum remains relatively weak. And when momentum is weak, caution is required. The big lesson. Let's compare the 3 market conditions. Strong trend. Large MACD peaks. MACD far above 0. Strong momentum. Higher probability, trend continuation. Choppy market. Small MACD peaks. MACD flattening near 0. Weak momentum. Frequent whipsaws and false signals. Range market. Small repeated MACD peaks. Oscillation around the 0 line. Lack of directional strength. Increased probability of failed breakouts. Notice something important. The MACD isn't just telling us direction. It's telling us the quality of the market. It's helping us distinguish between strength and weakness, between momentum and noise, between opportunity and risk. A simple rule you can use today. Before taking any trade, ask yourself one question. Is MACD expanding or shrinking? If MACD peaks are expanding, momentum is increasing. The probability of a successful trend is improving. If MACD peaks are shrinking, momentum is weakening. The probability of false signals is increasing. This simple observation can dramatically improve trade selection and reduce unnecessary entries. Conclusion. The market constantly rotates between trending conditions, choppy conditions, ranging conditions. The traders who survive are not necessarily the ones who find the most signals. They are the ones who recognize which market environment they are trading. MACD provides a simple yet powerful way to measure that environment through momentum. Large MACD peaks often confirm strong trends. Small MACD peaks often warn us about market noise and indecision. And repeated small MACD peaks inside ranges can alert us to potential false breakouts. Learn to read the strength of MACD, not just the direction, because momentum often reveals what price alone cannot. If you found this video helpful, subscribe to Alpha Trading Theater, hit the like button, and comment below. Momentum before entry. Because understanding momentum before entering a trade can be the difference between following a trend and chasing noise. Thanks for watching, and I'll see you in the next video.